and welcome to Talking Point. We have with us a very special guest. Joining us in the studios is Sumeet Nagar of Malabar Investments. More fondly known as, like Niraj says, the man of the Midas touch for the broader markets. Sumeet, Happy New Year and thanks a ton for joining us in the studios today.
Happy New Year and pleasure to join you guys.
Sumeet, I'm going to start more broad and then of course we'll narrow it down to stocks because we can't let you leave the studio without talking about stocks. I want to start by the year that's gone by. Nifty has gained, but the broader markets was largely the highlight, right? With mid and small cap gaining substantially, do you think gains into this year for the broader markets will be moderated? And also, let's not forget that India is become significant for the rest of the world, and FIs only literally joined the party towards the end of last year. So what lies ahead for the broader markets in 2024?
Okay, well, I'll start with a caveat that we're not market investors per se. We invest in companies, we invest in management teams. We look at the markets because that's the environment we play in, but that's not our primary focus. Having said that, I think what we saw in the markets in 2023 was sort of rising this wall of worries. I think when we started the year, I think 2022 wasn't a good year, and there were a lot of worries that existed in the beginning of 2023. And slowly as they receded, the market sort of continued its climb up. If you look at today, I mean, we think the market is reasonably well poised, right? So on the one hand, you have many positives, right? You have economy that's doing well, it's sort of gathering further pace. Your interest rates that have probably peaked out and they will come down. Macros are generally good. Commodities are benign. So these are all sort of good factors for the market. But on the other hand, you also have this worry of valuations being high globally. Maybe some sort of correction may happen. You've had such a steep rise in interest rates. Something somewhere breaks. There's slowdown or recession that people have been talking about. So these are the things that are the cause for worry. But the biggest one is that the markets are always forward-looking, right? So last year, even as things weren't that great, as they started to improve, markets already moved up. So some of this positive is already priced in, right? So where does that leave us? We think that there's still probably further upside because, as you pointed out, the rally only started in the last 2 quarters of the year, right? Just to point out, right, in the 18 months that ended in March 2023, we saw a massive amounts of foreign capital outflow, right? More than what we saw during the financial crisis. And it's only since April that foreign capital has started to come back. And what has come back is only maybe 2/3 of what had gone out, right? So there's still some of that capital has to come back and probably more, right? Because as you said, that India is becoming more prominent, people want to put more capital in. So these sort of flows have a momentum with them. They run for a period of time. And so that will likely continue for some more period, unless something big breaks somewhere. I think so. That's what you're seeing. But at the same time, I think the easy money of rising tide, raising all the boats, I think that's probably over. So now it will be sort of more selective. Wherever you see good performance, companies delivering earnings and cash flows, that's where you may see the upside, right? So that's our view on the market.
Sumeet, the last 6-8 months has been about government. It's been about sectors that the government is big on. So be it defensive, be it railway, it's largely been a top-down approach. Now, as we go into a time when valuations look slightly more frothy for the broader markets, would you advise investors to still, or rather now maintain, even more so now, a bottom-up approach? And it's all about companies as opposed to sectors? Strategic investing.
Yeah, so again with the caveat that we are always big believers in bottom-up approach. So, I'm just sort of repeating the same thing that I've ever said, that, you want to think top-down. You want to see where the world is heading, the trends that are coming through, what will benefit, but always invest bottom-up, right? Know the companies that you're investing in, what are their fundamentals, who are the people behind that business, do you trust them with your money, and only then you invest, right? So I think from that perspective, you can always find opportunities, right? So while, some of the government-related trends, they've actually worked well in the past year, but if you look at the long history, they haven't given consistent returns, right? So We generally stay away from that, but that's our choice. There are many other people who do that and do that successfully. But our main concern with those is that there is lack of clarity, lack of visibility, and whenever you're in these opaque situations, it's tough to bet on companies for the very long term, right? So for a shorter period of time, they may do well. And you can always find companies that benefit from those trends, right? So I think it's important to see the trends and see who benefits from that and invest in those.
Right, so talking about opportunities, and let's go quickly move into stocks because that's where your expertise clearly lie. I want to start with Newland, which has been a fantastic company. Growth in the CMS business has been amazing to say the least. High margin, good growth, delivered great returns over the last 4 or 5 years. Is the future as glorious for Newland, and does it look good even for a fresh investment at this stage?
So, I'm happy to talk about the stocks with the companies we invested in. People sort of know it's public knowledge. We own more than 1% in these companies, and we believe, very passionately about these companies. That's why we invested our investors' capital in them, right? But everybody should do their own work before they invest. When we talk about Newland, I think Newland is one of those companies where you have to build capabilities and trust over not years but decade plus in order for global pharma companies to trust you with their IP and with their new drugs. And that's something that Newland has done quite well. And the results of that, you're seeing that come to fruition now. And while they've had a very strong run-up, I would say the earnings have actually done extremely well. And so as a result, their valuation is still fairly reasonable, right? So they're in sort of low 20s PE for this year's earnings, and the business momentum is still quite strong, right? And if you look at long-term trends, I think the trend of newer innovative companies which are coming up without manufacturing facilities is only going to go up. And they will always look for reliable partners globally, and there are not that many of them. And so companies like Newland are in a very good position, who have done all the hard work to build the capabilities, to build the credibility, and now they're reaping fruits of that.
There's this belief, Sumeet, that the CDMO opportunity, while companies have scratched the surface, and maybe Divi's has been a leader there, but Divi's, Laurus, Newland, etc., over the next 4 or 5 years could see significant outsized opportunities relative to what they've enjoyed in the past. Is that something that you concur with as well? And rolled into that is the second question, that do Newland facilities right now have the ability to expand their revenue base without incurring too much of capex? Is the capex largely behind, or is it still to come?
Sure. So I think on the first point, I think the opportunity is clearly there and clearly growing, right? So I think the number of molecules and the size of molecules that are coming into India are increasing, right? Okay. And both are very positive trend for the industry. But again, I think it's really about each of the companies, what their capabilities are, who are the clients with whom they have built the trust, and then what are the things they're working on, right? Because what gives you the result today is the work that we've done over the last 2, 3, 4, 5 years, right? These are the molecules we've been working on, and only when they come up for commercialization is when you see the big benefit. The great thing about Newland is that they have been doing this hard work for the last decade plus, and many molecules are now sort of coming into that zone where they will get commercialized, and so they will see the benefit. So I think overall, for the industry, it's definitely a very good thing, and so is for Newland. In terms of the capacity-wise, they have capacity to cater to the growth that's currently there, and at the same time, they recently took board's approval to expand the capacity quite significantly. So they have an existing manufacturing where there's one more block that will come up, and that's very sizable, and so that can drive the growth for the next several years. But the thing here is that if the demand is there, capacity is an enabler. You'll always put it up. There's obviously some lead time to it, but if the demand is there, you can put up the capacity and you can cater to that.
Right. Moving on from one big performer to another, not such a great performer so far, is Hudson Agro. Dairy company in the south, they've expanded meaningfully. So, of course, haven't gone and said we're going to capture the world, but gone one step at a time. This, though, hasn't reflected in the numbers of Hudson Agro, right? The stock hasn't done too well either. You've been confident for many years now on the stock. One, when do you see this turning around for Hudson Agro, and also what makes you so optimistic? I mean, if you bet on this one for a very long time and you are unwilling to call it quits, I believe.
Yeah, I mean, there are certain companies that are just great compounders over the long term. The only difference is that each company compounds differently, right? So there are companies that will sort of eke out some level of returns every year. To, a lot of your, staple companies are like that, right? And that's why people like them. In some ways, dairy is one of the biggest staples that you can think of. Like, which family can live without milk, right? So dairy is one of the best staples that are around. It's just that because of the way milk gets priced and sourced and marketed, it leads to certain cycles. And so as a result, what we've seen with Hudson over the years, that if you're looking at any sort of 5-year chunks, there is a significant amount of compounding. But in between, you'll find 1, 2, 3 years where it doesn't do as well, because that's an environment where either the volume is impacted or maybe margins are impacted because milk procurement prices have gone up. But then you will get 1 or 2 years where suddenly you'll see a very, very big uptick, right? And so that's why we're confident. This is one of those companies that we know that 5 years from now, 10 years from now, 15 years from now, it will definitely be bigger than where it is today, right? And so they will keep compounding. You don't have any sort of risk of imports. You don't have any risk of AI. The milk is going to be.
Is that not a real problem?
In India, I mean, if you go deeper into India, India is largely a vegetarian country where dairy is the most important source of protein, right? And you cannot do without protein. And if anything, the need for protein continues to increase, right? Yeah. And so people will consume dairy. And then over time, they're obviously going into more value-added products, right? So if you look at their ice cream business, I mean, it's been growing gangbusters, right? They were predominantly south-based, but slowly they've been expanding into middle of the country, and they're top 3 ice cream makers in the country now.
Sumeet just simplifies this and makes it sound so simple, right?
Yeah, that's the idea, but really. and just wondering, Sumeet, I mean, for companies to last for 10, 15 years, there are multiple companies which do that. Mm-hmm. But for companies to last 15 years successfully is other thing. You expect the CAGR growth rates for a dairy business like led by Chandramohan to be a significant compounder? I mean, higher double digits, or how is it?
Sure. So, I mean, if you look at, this is a 50 years running. Mr. Chandramohan started this 50 years ago. And every 5-year chunk, it has grown, right? And so that's what gives and despite being the largest private sector dairy company in India, they are less than 2% market share. There's such a long runway to grow, right? The only thing is that this is not a business where you'll see 50% growth in revenue in a year. You can see in profits, but not in revenues. So revenues will keep chugging along. There's a 5% dairy milk consumption growth across the country. So that's the base, that's the support. There's some sort of milk inflation that sort of again adds to on top of that. And then they're gaining share, as they're expanding into other states. They're gaining share, right? They started from Tamil Nadu, now they're in 5 states. Now slowly they're getting into Maharashtra, right? So as they keep expanding, they'll gain share. And then share of value-added products will keep increasing, right? So your ice creams, your curd, these are better margin products growing at a much faster pace. So on the whole, they can deliver growth which is in the mid-teens or higher than that, which is very few FMCG companies are able to deliver, right?
It's only a matter of time that reflects in the stock price then.
Yeah, so I think it's, like I said, I think you'll find, if you go back in the history, you'll find 2-year periods where it doesn't do, and then suddenly, when you see the performance, you'll see a very, big step change. So that's why we have the comfort.
Round the corner is what Sumeet is
and not that I'm predicting, that in the stock, but if you look at the underlying factors, right? The margins bottomed out 2 quarters ago, right? Now they're sequentially, each quarter they're increasing. Year-on-year profit increase is quite strong now, right? And this is just the beginning, because what had happened was coming out of COVID, supply of milk had actually come down quite substantially. And it's not like a factory that you set up that you can say, oh, now from tomorrow 1 million more cows will start delivering milk. It doesn't work like that, right? And so that led to a very high milk price inflation, and that's what impacted the company's margins. But as supply has slowly increased, the milk prices have come off, and the margins are expanding. So there's no rocket science in that, right? It'll just play out like that.
Well, on that note, we'll take a quick break. We're in conversation with Sumeet Nagar of Malabar Investments. Sumeet, very quickly, we've talked stocks. You want to just give us a disclaimer?
Yeah, of course. These are stocks that we own in our portfolio for our investors. So we have, we're biased towards them. And as I said earlier, I think every investor should do their homework before they invest or evaluate investing in these companies.
And on that note, we will take a quick break. We'll come back and continue our conversation. Stay tuned.
With Talking Point on NDTV Profit in conversation with Sumeet Nagar of Malabar. Sumeet, it's great to identify businesses. I think that's what you identify yourself, so we'll stick to that. We're looking at some of the ideas that you've held for a while. I don't know your current status there, but one of the things that we've discussed in the past is Aptus Home. And considering the fact that everybody talks about real estate being in the mid of a multi-year cycle, home finance largely should do well. Has Aptus delivered as per your expectations from the time that you invested? If yes, then great. What do you expect it to? If no, then why not? And what's the way ahead?
Sure. So Aptus is a company that we invested in early 2019. We've been tracking since 2017. The company was still private then, so we invested while the company was private. And thereafter, a couple of years later, 2.5 years later, the company went public. Since we've invested till now, the company has delivered phenomenal results, right? Both in terms of its operating performance and also in terms of the returns over that time that it has generated. But again, just like we were talking about Hudson earlier, those returns have come in chunks. So from the time that we invested until the listing, the returns were phenomenal because we invested at a fairly reasonable valuation. When it got listed in late 2021, the market was very jubilant, so we got very good returns in that phase. Post that, the company's operating performance has been nothing short of superb, right? So in the 8+ quarters since going public, they have delivered better returns than most other financial companies in the country, right? Even during midst of COVID, they were able to grow their earnings in strong double digits, while pretty much every financial that you saw in the country saw a decline in their earnings. It was a very tough time. Most borrowers are not able to pay back and so forth, right? So it's a company that has had superb record of performance and resilience even during very tough time, and even now continues to deliver, revenue and earnings growth north of 25%, year on year, right? So it's a very solid performance. But what happened is, because it got listed at an elevated valuation, and post that, once the lockup expired, so the early investors were selling, it created that downward pressure. And when the downward pressure happened at a point in time, and in 2022, when the market was depressed, it resulted in the stock price coming down. Not related to the operating performance, which continued to be very strong. And so as a result, it got cheaper and cheaper and cheaper, right? And once that overhang got removed, sometime towards the end of last year, and people saw that the performance was so strong, this is a company that can grow at 25% for many, many years, available at 20 times the current year's earnings, and then the buying started to come. So now we have had some very well-reputed domestic or global mutual funds which are buying, and since that supply overhang is gone, you're seeing the pricing sort of move up. So in the last 9 odd months, they've moved up from that bottom. But even now, they're trading at about 25 times, this year's number. Not extremely cheap, but given their fundamentals, this is one of the most profitable financial companies in India, right? They have 16+% ROE, even with 1 plus X leverage, right? Their ROA is somewhere near 8%, which is just, it's not even sort of, it's tough to even call it best in class because it's so far above everybody else, right? So that's why we're very comfortable with a company like that. I think, they, it's a reasonable valuation today. Growth is quite strong. So the return should be in line at least with that earnings growth.
Which you believe is 25%.
Which
you
is
expect it to do 25%
at least in the 20 to 25% for next many years, right?
Got it.
And again, it's very underpenetrated, right? That's the thing, right? So we're talking about real estate and home finance, right? This is at 3 levels below, right? You're talking about affordable home finance, right? This is a home, their average ticket size is 8 lakh rupees, right? And this is in tier 2, tier 3, tier 4 of the country. It's also one of the segments that doesn't see the volatility like residential real estate in big cities, right? And so it's and you find the borrowers who are very creditworthy, that the banks just don't understand, cannot underwrite. So they're this unique position where they can they can lend at high enough yield to borrowers whose credit quality is actually on par, if not better than HDFC, right? And so that's where they earn very high level of spreads, and that's what leads to high ROA.
Would you look to add more to Aptus?
We added some during the past few quarters, right? So one of the funds we had to sell because we are returning capital to investors. But in one of the other funds we bought during this, when, as I said, a few quarters ago, when it was really so beaten down, it was a no-brainer.
Let's move on to another multi-bagger, Orion Pro. This one again is for the books, right? 30% growth over the last 3 years. You've also seen the stock to 500% this year. So it's defied logic in many ways. Management is talking about transformation. Corporate banking is their big bet. I believe also cloud service data centers. That's the other sort of big investment they're looking at. What are your thoughts on this one? What is the outlook on Orion Pro? Still looks great after such a sharp rally?
See, we like banking software plays. We've been an early investor in NewGen and still invested in that. That's been a great journey for us over the years. And what we realize that these companies are so deeply entrenched, right, that once you're in, you never would take them out, right? And unlike, let's say, software on your personal computer, these things actually require regular level of support, and that support actually goes up over a period of time, right? So once you're in, you have this annuity revenue that keeps continuing for many years to come, and that's the beauty of that business, right? Orion Pro is sort of in a situation where perhaps NewGen was, 5, 6, 7 years ago, right? So it's still relatively small. It has had good products that are well liked by the banks and used by the banks. But very importantly, I think the transformation that's taking place, it's with the management change, right? So you had, Paresh, who took over as chairman, Ashish, who came in, from one of the largest global companies. He was running their Asia sales. He came and took over as CEO. And with that change, they've brought in a very high caliber team to the company. So if you look at the team, that has evolved quite substantially. Existing team members have been empowered. They're going with much higher rigor to their customers. They'll be able to partner with global guys. And in that process, in the software business, a lot of the costs are actually fixed costs. So if you can drive high sales growth, it can lead to very high profit growth. And that's a journey that has just started for Orion Pro, and it can last for many, many, many years to come.
And that's not in the price.
I think it's moved up a lot, no question about that, but the earnings are also growing quite rapidly, right? And so if you look at, this year's earnings, maybe a little bit more expensive, but if you fast forward by a year, they're still trailing, sub 20x multiple, right, for next year's. And the growth will continue beyond that. So that's the interest and excitement in companies like that.
One quick thing there. By the way, it seems like you're betting on companies which will have multi-decades of growth and you don't have to do any work on a given day.
Strategic investor.
Yeah, just strategic investing. But yeah, Vaibhav Global, very quickly, Sumeet, we have about a couple of minutes. A business that is, from amongst all the others, has kind of flattered to deceive, you would agree? I mean, the numbers don't quite do justice, especially in the bottom line.
Yeah, so this is again very similar story as Hudson, right? If you look over long term, they've created a lot of value, but again, it has tended to come in chunks of time, right? Last 2 years have been quite tough because, you saw during and post-COVID, they had phenomenal performance because everybody wanted to buy things online or remotely, and it led to an artificial high, right? And from there, sales have sort of come off a little bit, and it's a business with very high fixed costs, right? So even a small decline in the top line results in a very magnified impact on the bottom line, right? And on top of that, they made two decisions which were negative in the short term, but very beneficial in the long term. One was to put a robotic distribution system, which obviously in the beginning resulted in additional costs, but it's now leading to much better productivity and much better sort of cost optimization. But in the short term, it led to a hit on the earnings. And the second one was expansion into Germany, which again, because it's a business where you don't buy capacity, right? You invest through OPEX. It resulted in a hit on P&L, which you take up front, but it has resulted in expanding companies' addressable market quite significantly, right? So I think those two steps, which we believe are good long-term steps, created an impact on the short term. Those things will recede, and eventually they will perform.
Because over the last 5 years, its compounded profit growth has been a mere 1.5%, 2%, right?
So, but it's just, again, it's because the profits declined quite substantially in the last year plus on the basis of a very minuscule drop in revenues, right? So the profits can actually expand very, very significantly on the way up, right? It takes, even with 10, 15% revenue growth, they can deliver 30, 40, 50% revenue growth. And again, just like I was saying in case of Hudson, you can see this sequentially, that the margins have started to improve, right? So we believe the worst is over, and now you will see that uptick coming up.
Very quickly, on existing portfolios, are you sitting on cash at all, or are you fully invested, not new money?
We have a little bit of cash, but it's on the lower side, right? So it's maybe in that 5% range, depending on the funds that we're in, but it's still on relatively low side because we're finding good opportunities. Yeah.
So finding value still.
We're still invested. In the past year, we have made several investments, right? Some of which we discussed. Some existing portfolio companies
and some that we'd like to discuss, but we don't have time, which is AMI Organics, PDS. Those are a few recent buys as well, that you've increased your stake in those companies. But great having you in the studio, Sumeet. Pleasure talking to you about a few of your investments.
Pleasure in mine. Thank you.
Certainly. Thank you for joining it.
Thank you.
And viewers, thanks for tuning in.